Imagine waking up tomorrow, pouring your morning coffee, and realizing you no longer feel the urge to check the stock market, the financial news, or the latest expert prediction. No anxiety, no panic scrolling, no fear of missing out. Just quiet confidence that your money is working for you in the background. That's exactly what we're talking about today. Before we dive in, take a quick second to hit the like button and subscribe to this channel, because we break down money strategies that actually work in real life, without hype, without scams, and without stress. Now let's get into the lazy way to beat the stock market and why it works better than you might think. The modern financial news cycle is designed to hijack your emotions. Every headline is either screaming about an imminent market crash or hyping the next once-in-a-lifetime opportunity. Red arrows, green arrows, breaking news banners, urgent alerts, all of it is engineered to keep you glued to the screen and emotionally reactive. And here's the uncomfortable truth. The more emotional you are about investing, the worse your results usually become. When people invest based on fear, they sell at the bottom. When they invest based on excitement, they buy at the top. In both cases, they lose money. That's where lazy investing flips the script. Lazy investing isn't about being careless. It's about being disciplined in the simplest possible way. Instead of trying to outsmart millions of traders, massive hedge funds, and algorithmic supercomputers, lazy investors accept a powerful reality. You don't need to beat the market to win. You just need to own the market and give it time. Let's talk about why boring is beautiful. In entertainment, boring is bad. In investing, boring is brilliant. The investments that generate the most hype are usually the ones with the highest risk. Day trading, meme stocks, hot new cryptocurrencies. These strategies look exciting on social media because people post their wins and hide their losses. What you don't see are the countless silent accounts that got wiped out chasing the same trends. Exciting investments depend heavily on perfect timing. You have to buy at exactly the right moment and sell before everyone else rushes for the exit. Even professionals with decades of experience fail at this consistently. Boring investing, on the other hand, relies on something far more powerful than prediction: probability and time. Historically, the overall stock market has gone up over long periods, despite wars, recessions, political chaos, and global crises. Lazy investors aren't trying to guess tomorrow's headline. They're betting on decades of economic growth, innovation, and productivity. And that bet has paid off again and again. Now let's address the trap of stock picking. Everyone wants to find the next Amazon or Tesla. The idea of turning a small investment into a fortune is intoxicating. But here's what rarely gets talked about. Most individual stocks underperform the market, and many of them lose money entirely over their lifetime. The market's massive gains don't come from thousands of winners. They come from a small handful of superstar companies that carry the entire index upward. When you try to pick individual stocks, you're essentially playing a lottery where the odds are stacked against you. But there's a smarter move. Instead of trying to find the needle in the haystack, you buy the entire haystack. That's exactly what index funds allow you to do. An index fund is a simple but powerful tool. It doesn't try to be clever. It doesn't attempt to predict the future. It simply tracks a broad group of companies. One of the most popular examples tracks the 500 largest publicly traded companies in the United States. When you invest in that fund, you instantly become a partial owner of hundreds of major businesses across technology, healthcare, finance, energy, and more. Here's why this is so effective. If one company fails, it barely impacts your overall investment. If a new superstar company rises to the top, it automatically becomes part of your portfolio. You don't need to guess who the winners will be. You already own them. And the data backs this up. Over long time periods, the overwhelming majority of actively managed funds, where professionals try to beat the market, end up underperforming simple index funds. Think about that for a second. Highly paid experts with access to insider research and advanced tools still lose to a strategy that anyone with a smartphone can use. That's not luck, that's math. Now let's talk about the engine that makes lazy investing even more powerful: dollar cost averaging. This sounds complicated, but it's incredibly simple. You invest a fixed amount of money on a regular schedule. Every month, every paycheck, or every week. Same amount, same routine, no emotion involved. When the market is high, your money buys fewer shares. When the market drops, your money buys more shares. Over time, this averages out your purchase price and reduces the risk of investing everything at the wrong moment. Instead of trying to time the market, you let time work for you. Automation is the secret weapon here. When your investments are automatic, you remove yourself from the decision-making process. There's no debate, no hesitation, no waiting for the perfect moment. The money moves in the background while you focus on your life. Now let's look at what happens when you combine this with patience. Imagine you invest a modest amount every month for 20 years. You don't touch it. You don't panic sell. You don't chase trends. You just let it grow. Over time, your contributions add up, but the real magic comes from compound growth. Your returns start generating their own returns. The growth accelerates. What starts slow eventually snowballs. This is why time in the market matters more than timing the market. The earlier you start, the more powerful the effect becomes. Even small amounts can turn into significant sums when given enough time. But here's the part most people struggle with: doing nothing. Lazy investing sounds easy on paper, but emotionally, it's hard. When the market drops sharply, fear kicks in. The news will tell you to sell. Social media will be full of panic. Friends and coworkers will start talking about pulling their money out. This is the moment where long-term investors separate themselves from short-term thinkers. Selling during a crash locks in losses. Staying invested allows you to benefit from the eventual recovery. Historically, markets have always recovered and reached new highs over time. The people who win aren't the ones who predict crashes. They're the ones who survive them. There's another psychological trap: comparison. When someone you know brags about doubling their money on a risky investment, it's tempting to abandon your boring strategy. But remember, you're not seeing the full picture. You're seeing a highlight reel, not the blooper reel. Consistency beats flashiness in the long run. Lazy investing isn't about getting rich overnight. It's about building wealth slowly, quietly, and reliably. It's about setting up a system that works even when you're busy, tired, or distracted. It's about freeing yourself from the emotional roller coaster of daily market noise. So here's your simple mission: own the market instead of trying to beat it. Invest regularly instead of waiting for perfect timing. Stay consistent instead of reacting emotionally. And most importantly, give your money time to grow. While everyone else is glued to breaking news alerts and market drama, you can focus on building your career, enjoying your family, and living your life. Your investments will keep working in the background, compounding quietly, without stress. That's the lazy way to beat the stock market. Not by doing more, but by doing less. Not by being smarter than everyone else, but by being more patient. And years from now, when you look back at your portfolio and realize how far you've come, you'll be grateful you chose the boring path. Because in investing, boring isn't boring at all. It's powerful.